Dear students, in this session we will clarify a few more points associated with the national income accounting. We start with gross domestic product, GDP. GDP, as we have discussed in the previous classes, is a measure of all currently produced final goods and services evaluated at market prices. Is a measure of all currently produced final goods and services evaluated at market prices. We will clarify these points once again. Like the accounts of a business firm, national income accounts have two sides. One is the product side. The other one is the income side. The product side and the income side. Product side is a measure of production and sales. Income side is a measure of the distribution of the proceeds from the sales. From the product side, we have two measures, GDP and GNP. GDP and GNP. And the distinction between these two is the way in which we treat international transactions, something which we have explained in detail. From the income side, we have what is known as national income. So these are the three totals often used as measures of national income. Now, as it is clear from the definition of GDP, we consider only currently produced goods and services. Currently produced goods and services. So GDP includes only currently produced goods and services, that is goods and services produced per year. So exchange of goods and services produced during a previous year will not be included in GDP. Also, exchange of assets such as stocks and bonds are also not included in GDP, something which we have discussed. The second aspect of the definition is we will include only final goods and services. Final goods and services. We will include only final goods and services. Only production of final goods and services are included in GDP. Goods used for the production of other goods and services, known as intermediate goods, are excluded. The reason is that the value of these intermediate goods are included in the final goods. So if you include the value of intermediate goods, you will face a problem known as double counting. Double counting, a point which we have already considered. Even though we include only the value of final goods and services, we include two types of goods used in the production of other goods while calculating GDP. That is, we will include two types of intermediate goods while calculating GDP. One is currently produced capital goods. Currently produced capital goods known as plants and equipments purchases by business firms. We know that capital goods are ultimately used up in the production process, but in the current year, only a portion of the capital goods, only a portion of the plant and machinery will be used up in the production of other goods and services. This portion is known as depreciation. So if a business firms purchases capital goods worth say $1,000 billion, and suppose that $100 billion depreciated. So only $100 billion, that is the depreciated portion of the capital goods, will be embodied in the value of final goods and services. So if you do not include value of these capital goods in GDP, then you are implicitly assuming that all the currently produced capital goods are fully absorbed or fully embodied in the final goods and services. But this will not happen. But there is one problem here. In GDP, we include the whole value of capital goods as a separate item. And when you include the whole value of capital goods as a separate item, there is some double counting, because the portion of the capital goods which is depreciated is included in the value of final goods and services. So this $100 billion is included in the final goods and services, and also this will be added as expenditure on machinery and plants. So this 100 will be double counting. But as we have discussed earlier, if we subtract depreciation from the calculation of GDP, we will get a measure of the output of goods and services which is free from double counting. That is a concept which we have discussed. Then that is one. That is the first category, which is actually intermediary but included in national income. The second category is inventory investment. Even though inventories are used up in the production process, it is included as a separate item. And inventory involves two things: net change in inventories of final goods available for sales. That is, goods and services produced but not sold. While calculating national income from the product side, we calculate national income when it is actually purchased. So if a final good is produced but not sold in the market, it is part of inventory. The second inventory is materials used in production process. Materials used in production process. So additions to inventory stock of final goods belongs to GDP as they are currently produced final goods. So it must be included. But it will not be included when this final good is sold to the consumers at a later stage. And also inventory investment in materials belongs to GDP because it also involves current production whose value is embodied in the current sales is not embodied in the current sales of final goods. For example, wheat supplied by the farmer but not used up in producing bread is intermediary, but it generates income, so it must be included. So two types of goods used in the production of other goods are included in GDP. One is currently produced capital goods used as plant and machinery. The second is inventory investment. And the third point is GDP is the value of final goods and services evaluated at market prices. Evaluated at market prices. So we will not include those services which are not sold in the market. For example, the service of a housewife. It is not evaluated at a market price, so not included in national income. Also, non-reported output from illegal activities such as sales of narcotics, gambling, etc., not part of national income. And for some services, we impute the value because these services will not be sold in the market. For example, services of owner-occupied houses. You have constructed a house and you are living in the house. You are not paying any rent to anyone. But if you sold out, if you rent your house to someone, you will get a payment. So a value equal to the rent will be imputed as the payment to the services of house, buildings, etc., occupied by the owner himself. So there are many other services whose values are imputed. We will see some cases at a later time. So this is a repetition only. Remember this. We have GNP calculated from the product side, income side. In the product side, we consider only currently produced final goods and services evaluated at market prices. So in the case of inventories, remember this. As inventories or goods and services produced but not sold to the consumers, we assume that it is purchased by the owner himself. And this is included in inventories. So suppose a farmer produces 100 kilos of rice. He was able to sell only 50 kilos. So the remaining 50 is considered as inventory of final goods, and we assume that this 50 kilo is purchased by the farmer himself and is included in GNP. When this 50 kilo is sold to the final consumers at another time period, it is not considered as part of GNP because it is not currently produced goods and services. And in the next class, we will consider an example based on the US economy to clarify these points.